Morgan Stanley just made a move that changes everything you thought you knew about Bitcoin and institutional money. They launched their first ever bank-branded Bitcoin ETF in April 2026. And this is not some experimental side project. This is a full-throated institutional endorsement, while Bitcoin trades at $72,400 following the March inflation data release. The same week, Bitcoin posted a 9% gain, its best weekly performance since October 2025. But here is what nobody is telling you. When a banking giant like Morgan Stanley enters the Bitcoin ETF arena, they are not chasing retail hype. They are positioning for a macro shift that most investors will only recognize in hindsight. The March 2026 CPI data came in hotter than expected, yet Bitcoin rallied. That inverse correlation is not random. It signals that institutional capital is treating Bitcoin as a hedge against currency debasement, not a risk-on tech play. Morgan Stanley's timing reveals their internal macro thesis. They see the Federal Reserve trapped between inflation persistence and economic fragility. The ETF launch is their public declaration that Bitcoin is now a portfolio allocation tool, not a speculative gamble. Let me show you the data that confirms this institutional pivot. Bitcoin institutional demand surged 340% in Q1 2026, according to on-chain analytics. That number comes from wallet addresses holding over 1,000 BTC, the signature of institutional accumulation. Meanwhile, retail wallet activity remained flat, meaning smart money is buying while dumb money sits on the sidelines. The second data point is the ETF flow divergence. In the 2 weeks leading up to Morgan Stanley's launch, spot Bitcoin ETFs saw $2.1 billion in net inflows. Compare that to the $890 million outflows from traditional bond ETFs during the same period. Institutions are rotating out of fixed income and into Bitcoin as a duration hedge. This is not a speculative bet. This is a strategic reallocation driven by macro reality. Now let me translate this into actionable positioning. 3 tickers are screaming institutional accumulation right now. First, MSTR, MicroStrategy, the corporate Bitcoin treasury play. They hold over 214,000 BTC as of April 2026, and their stock acts as leveraged Bitcoin exposure with a corporate wrapper. When Morgan Stanley launches a Bitcoin ETF, MSTR becomes the liquid proxy for institutional flows that cannot directly buy crypto. Second, IBIT, BlackRock's iShares Bitcoin Trust. This ETF has absorbed $18 billion in assets since launch, making it the fastest growing ETF in history. Morgan Stanley's entry validates the entire spot, Bitcoin ETF category, and IBIT is the liquidity king. Third, ETHE, the Grayscale Ethereum Trust. Ethereum is trading at levels that suggest it is next in line for the institutional adoption wave. If Bitcoin is digital gold, Ethereum is the programmable settlement layer for decentralized finance. Morgan Stanley chose Bitcoin first, but their ETF infrastructure can easily expand to Ethereum once regulatory clarity improves. These 3 tickers represent the institutional on-ramp to crypto exposure without the custody headaches. Now here is the historical parallel that will give you chills. In November 2004, the first gold ETF launched. Ticker GLD Gold was trading at $450 per ounce when GLD went live. Over the next 7 years, gold rallied to 1,900, a 400% gain. The ETF structure removed friction, brought institutional capital, and turned gold from a fringe asset into a mainstream portfolio allocation. Bitcoin is following the exact same playbook in April 2026. Morgan Stanley's ETF is the institutional permission slip. Before GLD, owning physical gold meant storage, insurance, and liquidity risk. After GLD, it became a single ticker in your brokerage account. Before spot Bitcoin ETFs, owning BTC meant exchange risk, private key management, and regulatory uncertainty. After Morgan Stanley's ETF, it becomes a line item in your 401k. The 2004 gold ETF launched during a period of currency debasement fears. Just like today, the Federal Reserve had slashed rates to 1% after the dot-com crash, and inflation was creeping higher. Investors needed a non-sovereign store of value, and the ETF made gold accessible. In 2020, the Fed is stuck at restrictive rates while inflation refuses to die, and Bitcoin is the new non-sovereign hedge. The parallel is not perfect, but the macro setup is eerily similar. Morgan Stanley is not guessing. They are reading the same historical playbook that turned gold into a $13 trillion asset class. Here is the part that separates smart money from dumb money. Retail investors will chase Bitcoin after it hits $100,000 and the headlines scream about new all-time highs. Institutional investors are buying right now at $72,400 while the narrative is still uncertain. Morgan Stanley's ETF launch is the signal, not the starting gun. By the time CNBC is running 24/7 Bitcoin coverage, the institutional positioning will already be complete. The opportunity is not in the rally, it is in the accumulation phase before the rally. That phase is happening right now in April 2026, and most investors are missing it. One more thing you need to understand about this macro shift. Bitcoin's 9% weekly gain is not just a technical bounce. It is a repricing of risk in a world where fiat currency is losing credibility. The March CPI data showed inflation is not transitory, it is structural. When inflation persists despite restrictive monetary policy, investors start questioning the purchasing power of cash. Bitcoin becomes the logical alternative, and Morgan Stanley just validated that thesis with billions of dollars in ETF infrastructure. This is not a trade, this is a generational wealth transfer. The institutions that understand this are positioning now, and the ones that do not will be buying at the top. You have a choice. Follow the smart money or become the exit liquidity for the smart money, Morgan. Stanley just showed you which side they are on. The question is, which side are you on? This analysis is for educational purposes only and does not constitute financial advice. Consult a licensed financial advisor before making any investment decisions. All investments carry risk, including the potential loss of principal